Welcome to the deep dive. Today we're cutting through the noise, really getting into some pretty provocative material about the silver market. Specifically, we're looking at these urgent warnings from Mario Innecco. You might know him online as Monko64. He's claiming a major systemic crisis isn't just coming, it's already happening.
Yeah, and you really need to get the scale of what he's saying right from the start. I mean, he's not just talking about, a bit of market wobble. He actually calls this the mother of all squeezes. And he goes even further, saying if this whole paper market control breaks down, it could genuinely shake the entire financial system.
Shake the whole system. That's huge.
It is, because, in his view, the ability to keep gold and silver prices down is sort of the last pillar holding up what he calls the fiat currency Ponzi scheme. That's the core of it.
Okay, wow. So let's unpack that. The main accusation, his central claim, is that the big players, the London Bullion Market Association, the LBMA and COMEX over in New York, that they've essentially been acting as, well, his words, paper peddlers, and even more strongly, glorified bucket shops, creating this massive digital illusion when it comes to actual physical metal.
Exactly. And to get how this alleged deception works, you have to look at the LBMA first. It runs this enormous over-the-counter market for metals globally. It's not like a normal exchange. It's traded sort of peer-to-peer on the foreign exchange market. And the critical bit Innecco keeps hammering is that it's, well, very thinly regulated.
Thinly regulated compared to what, like the futures markets?
Yeah, compared to, say, the CFTC regulated futures market in the U.S. If you're selling synthetic stuff, paper claims less regulation means less scrutiny, doesn't it? So the core accusation is simple. For decades, big bullion banks working through LBMA and COMEX have just sold way, way more gold and silver claims than they actually hold in physical form.
Selling the same ounce multiple times over, basically.
That's the idea. A kind of fractional reserve system, but for commodities. And that's why he uses that really loaded term, glorified bucket shops. You remember those old bucket shops, places where you bet on stock prices, but the shop itself never bought the stock. You were just betting against the house.
Right. They just paid out if you won, took your money if you lost, but no real shares changed hands.
Precisely. Innecco's arguing the LBMA and COMEX are kind of like that today. When you buy a paper contract or an unallocated account, you're almost never getting title to specific physical metal. You're mostly just getting exposure to the price managed by the banks.
And this whole idea, collusion, price suppression, it's not entirely new, is it? Thinking back, there was that group, GATA.
The Gold Antitrust Action Committee. Yeah, GATA. They formed way back in 1998. Their whole mission was to expose and fight what they saw as collusion between governments and banks to control gold and silver prices.
So what GATA was warning about back then, Innecco's saying we're seeing the consequences now.
That's exactly it. The historical context matters, because what GATA flagged as a risk, this systematic suppression through paper trading, Innecco argues, is now being broken by real-world physical demand. The paper illusion is cracking.
Okay, so that takes us straight into the evidence. You said the cracks are showing. What are the specific signs that this paper system might actually be failing now? He says the price action is impossible to hide.
Well, there are a couple of really big signals, and they both point towards physical metal just vanishing. First, pretty straightforward. Physical silver supplies are genuinely drying up. You hear it from dealers, mints. But the really key technical signal, the one that gets traders worried, is this inversion in prices. Normally, the futures price for delivery later is a bit higher than the spot price, the price for right now. That difference covers storage, insurance, stuff like that. It's called contango.
Right. Contango suggests there's plenty of metal available down the line, but we're seeing the opposite.
Exactly. We're seeing backwardation, sometimes deep backwardation. The spot price for immediate physical delivery is spiking way higher than the futures price.
And why is that such a big deal?
Because the futures price is mostly set by the paper traders, right? The banks, the algos, rolling contracts, rarely taking delivery. When the spot price surges much higher, it screams that people needing actual physical metal right now are desperate. They'll pay a huge premium today. It shows that the paper market, which is supposed to reflect the physical, isn't keeping up. Innecco says it proves the real metal is disappearing, even while paper contracts keep trying to weigh down that futures price.
And there's data on the physical side, too. You mentioned London vaults.
Yeah, the inventories in the London vaults, which are meant to back the LBMA system, they're reportedly down, more than 25% just since 2021. That's a huge drop.
A shrinking pile of actual metal trying to support this potentially vast mountain of paper claims. That sounds precarious.
It is. And the way they managed this juggling act for so long according to the sources, involves a mechanism called EFP, exchange for physical. This is supposedly key to the whole liquidity illusion.
EFP, exchange for physical. Okay, how does that work? You called it a loophole.
Yeah, described as a major loophole. It basically lets banks settle futures contract obligations, say, on COMEX, by swapping them for an over-the-counter position, often on the LBMA in London. So instead of having to find and deliver physical silver in New York when a COMEX contract expires, they can essentially just swap it for a paper promise in London.
Wait, so it allows them to avoid delivering the actual metal?
That seems to be the function, yes. It facilitates moving the obligation across borders, turning a potential physical demand into just another rolling paper liability. It avoids the moment of truth, you could say, where they might have to prove they have the physical bars. Good for the banks needing to avoid delivery, and maybe convenient for some clients who just want paper exposure anyway.
And it's not just Innecco pointing this out, is it? You mentioned even big banks are noticing the tightness.
That's right. The sources point out that even major players, banks like HSBC and UBS, they've had to raise their silver price forecasts for 2025, and they're apparently admitting the supply situation is tighter than anything they've seen before.
When the mainstream banks start saying things like that.
It suggests the underlying physical pressures are becoming undeniable, even to them.
Okay, so connecting these market mechanics back to the big picture, the monetary stakes. Why silver? Why does Innecco see this specific market as so critical?
Because, he argues, you can't keep a global fiat system based only on trust and government promises going indefinitely if you can't control the price of the real alternatives, gold and silver. They're the assets governments can't print. If their prices truly reflect real-world demand and the debasement of currencies, they basically expose the fragility of the whole debt-based system.
And the scale of that debt is just astronomical, isn't it? What are the numbers?
The figures cited are pretty stark. Total global debt is somewhere near $330 trillion, and U.S. public debt alone is closing in fast on $38 trillion.
Wow. So the argument is governments print money to cover spending and delay the inevitable. Central banks inflate asset prices. But gold and silver prices, if uncontrolled, would reveal how unsustainable that is.
That's the core idea. If silver, specifically, which has been heavily suppressed according to Innecco, breaks free due to physical shortage, it sends a shockwave. It signals that maybe the emperor has no clothes, financially speaking.
But hang on, let's push back a bit. Is silver really that central? I mean, does the average person on the street even know what backwardation is or care about LBMA vault levels? Isn't it a bit of a niche market to be a global linchpin?
That's a totally fair question. And no, the average person probably isn't tracking silver future spreads. But the point isn't about public awareness directly. It's about the institutional function. If, as Innecco alleges, silver's price has been a key mechanism used by institutions to suppress broader inflationary signals and maintain confidence in the paper system, then the failure of that mechanism is systemic. It doesn't matter if the public understands the details, the confidence shock would ripple outwards.
So the prediction then is, what? If the squeeze is real, where does the price go?
The prediction is pretty blunt. The only way to resolve this physical shortage is through price. Price is higher, much higher than current levels. And he believes this inevitable price surge will completely discredit the LBMA and its paper model.
Discredit them, like expose the whole thing as a sham.
Essentially, yes.
Yeah.
It's framed less as just a market call and more as a kind of reckoning for the institutions he sees as having run this paper game for decades. When trust is the only thing backing $330 trillion in debt, physical gold and silver become, well, monetary lifeboats.
You know, this whole paper versus physical thing, it can still feel a bit abstract, but Innecco shared a personal story that really seems to make it concrete. About Citibank.
Yeah, this is quite revealing. It was back in the early 2000s. He bought gold for his mother, thought he was doing the safe thing, using Citibank in Switzerland. You know, Swiss bank, gold. Sounds secure, right?
Definitely sounds secure. So he thought he owned physical gold in a vault somewhere.
That was his understanding. But he'd been reading Gada, getting suspicious about the paper markets. So, a few months later, he decided to test it. He contacted the bank and said, "Okay, I'd like to take delivery of that gold now, please. Physically."
What happened?
That's where it got interesting. The bank apparently freaked out, refused the request initially. They were so concerned, they actually arranged an emergency meeting with him in London to discuss why he wanted the physical metal.
An emergency meeting just to take delivery of your own gold? That sounds odd.
Extremely odd. And during that meeting, the truth finally came out. The bankers admitted he hadn't actually bought allocated physical gold. He had bought something they called FX gold.
FX gold? What on earth is that?
They explained it was basically a paper derivative, an exposure linked to the foreign exchange markets, not actual metal. A digital representation, essentially. An illusion, as he saw it.
Wow, so not real gold he could hold.
Exactly. And that led him to ask the killer question. He asked them, look, if I'd bought euros through you instead another foreign exchange transaction, surely I could withdraw those euros in physical cash notes, right?
Yeah, that makes sense. You buy currency, you should be able to get the cash.
Right. So he asked, if this gold was just an FX position, why couldn't he take delivery of the underlying asset, the gold, just like he could with currency?
And what did they say?
According to the source, they literally couldn't answer that question. They had no logical response. And for Innecco, that was the moment. It confirmed everything he suspected about the banks just being paper peddlers.
So what did he do?
The consequence was immediate. He closed the Citibank account, took the cash value, walked over to Credit Suisse in Zurich, bought actual physical gold coins and bars, and took them home for his mother. Made the distinction brutally real.
That story really does crystallize the whole paper versus physical issue, doesn't it? It brings it down to a personal level.
Absolutely. And it ties right back to the current situation. His argument is that the entire global trading system, LBMA, COMEX, it's built on these paper claims. And when real physical demand finally overwhelms the paper supply, the system breaks. It can't deliver.
So wrapping this up, the main takeaway from Innecco's analysis, the bottom line for you listening, it seems to be less about fear-mongering and more about just financial realism.
Yeah, I think that's fair. It boils down to that old saying, really, if you don't hold it, you don't own it.
Yeah.
He also quotes, truth is the daughter of time, implying the time for the truth about the paper-silver market is finally arriving.
Which leaves us with a pretty pointed question for you to think about. If your security is tied up in paper gold or silver stored somewhere you can't physically access, what happens if delivery fails tomorrow? If those London vaults, for example, are genuinely running low, will your provider hand over real metal? Or will you get some kind of digital apology, maybe like that FX gold explanation Innecco got? If the system relies on suppressing the price of something like silver to keep that $330 trillion debt mountain looking stable, what happens to confidence when the physical metal just runs out?